Paul Doherty from Eisner Amper. He's going to bring us up to date on some S-Corp basis issues. I know all of us sitting here have gone through these issues. We get to the S-Corp tax return, there's a loss. And we're trying to figure out whether there's basis or not to take the losses. Very complicated. Shareholders borrowing money back and forth, putting money in. So hopefully Paul's going to shed some light on that today and give us a nice update.
Thank you. Good afternoon, everybody. Happy September 17th. I see a lot of smiling faces out there. Today we're going to talk a little bit about basis and related party S corporations, and I think this topic is pertinent for a couple of reasons. First of all, I think if your clients are like mine, every time they have an idea, they set up a new company or a new entity, and every time they do that, now you have the issue: whoever has the money pays the bills. And at the end of the year, we're given the trial balances and we're supposed to figure out, can we take the losses? Some of them have losses, some of them have income. How do we allocate the expenses? And do they have basis to take these losses? So I think it's pertinent from that perspective that it probably impacts a big part of our client base. The second thing is it's been a very hotly contested issue with the IRS. So what we're going to try and do today, I just want to go through, I guess, a little bit of the present law, go through some history, go through some recent cases, a case that came out in 2012, the McGuire case, go through proposed regulations that came out right around the same time as the McGuire case, and then end up maybe talking a little bit about some practical considerations that we can apply to our clients as we're coming into the year end. And as I said, what's at stake with this issue? With these new developments, perhaps we have closure to a long unsettled issue with regard to basis between related S corporations. We have to determine whether or not our clients can take the losses. Are our clients at risk for examination? And if they are at risk for examination, what can we do to strengthen our case so we put the best case forward for our clients? And lastly, like I said, how can we effectively plan for our clients given these new developments? First, just want to go through some of the basic rules of what gives an S corporation shareholder basis, and some of these, most of these we all know. First is contributions to capital to the S corporation. That one is pretty easy. The shareholder contributes money directly to the S corporation in the form of capital or in the form of a loan. Next is unencumbered funds lent by the shareholder or funds borrowed by the shareholder for use in the corporation activities. So this would be the case where the shareholder goes to his home equity line or secures a loan himself and then turns around and loans it to his S corporation. Another way you can get basis is if you receive shares as compensation. So to the extent that you're picking up income, you're going to get basis in the S corporation stock for those shares. Another way to get basis is through payment of a corporate debt. So if the S corporation has a bank loan and the shareholder pays that bank loan, or if the shareholder pays accounts payable, that's a direct payment by the shareholder on behalf of the corporation. You're going to get basis. And lastly, if the shareholder assumes the corporate debt, and here you have to be careful because the shareholder actually has to assume the debt. They have to be looked at as the primary obligor on that obligation, and they have to be making the payments. So now let's just talk a little bit about possible related party loan scenarios. And I guess there's two diagrams up here, but there's probably 4 possible scenarios because there's 2 for each. First, you have, if you have a shareholder that owns 2 S corporations, one way they can get money from one S corporation to another is for the S corporation A, in this example, to distribute cash to the shareholder, and then the shareholder turns around and contributes that same cash to S corporation B. So in that case, you would have a distribution and a contribution. Another way, using the same diagram, is if S Corporation A loans money to the shareholder, and then the shareholder loans the money to the S Corporation.
Probably 4 possible scenarios, because there's 2 for each. First, you have a shareholder that owns 2 S corporations. One way they can get money from one S corporation to another is for S Corporation A, in this example.
Whoever's on the phone, could you mute your line, please? You're coming through.
On.
That was throwing me off, sorry.
It was you.
There's an echo in here. The second scenario that you could have is if you have 2 S corporations and S Corporation A loans the money directly to S Corporation B. And again, that's a loan, and the question is to whether or not you get basis and whether or not that's treated as a loan from S Corporation A to the shareholder and then a loan back to S Corporation B. So this is what we're going to spend some time talking about, and then we'll go through. You'll see the cases are kind of all over the place, or were all over the place. And then in 2012 we had the McGuire case, and then we had the proposed regulations under Section 1366. So there was a couple of cases that ruled in favor of the S Corporation shareholder. The first one was Coleman versus the Commissioner, and again it was very similar to the diagram that I had laid out. Coleman had owned one S Corporation with a profit and another S Corporation with a loss, and the one with the profit made a direct payment to the one with the loss, and they treated it as if it was a shareholder loan and took the losses. In that case, the IRS, and there's a couple of doctrines that the IRS argues in this case. First, you'll see they're consistent. The IRS says that, number one, there has to be a direct loan. The money has to go direct from the shareholder to the S Corporation. And the second thing that's more problematic is this doctrine of economic outlay. And they say that there has to be an actual economic outlay, and that the shareholder has to be poorer in a material sense. Not sure where they got that from, but that was where a lot of the litigation came from, was this economic outlay doctrine. But in the Coleman case, I guess the tax court found that the taxpayer was meticulous and consistent with the treatments and the payments, and they ruled in favor of the taxpayer in this case. Yates was a similar case to Coleman and also found in favor of the shareholder. Here, Yates had 2 S corporations. He made a direct payment, and rather than treat it as a loan, he treated it as a distribution from a deemed distribution from S Corporation 1 and a deemed contribution to S Corporation 2. And again, he was successful, and the IRS made the same argument. There was no economic outlay here, but the taxpayer prevailed. Yes?
What would be, if we came to you and asked the question which way we should be set up to move our money back and forth, would you do it the way the court case ended up, or would you go back to your example?
Actually,
Sorry, could you repeat the question? Just
yes. The question was, if somebody came to me for advice, how would I set this transaction up? Would I set it up the way the court case or the way I had discussed it in my previous example? Is that correct? And I think we're going to get to that at the end, I mean, with the McGuire case and the regulations. But I think, to answer the question, I think, you know, however you do it, you have to make sure you document what we're doing. So if we're going to do it through a journal entry and say it's a deemed contribution and a deemed distribution, and we'll get into this in the McGuire case, but you know, document it in the corporate minutes. Make sure you record it, make sure you have a note in place, make sure there are payments, you know, put all that in place. My preference, if I'm advising a client, is to actually cut the check and then contribute it. I mean, I think you can, you know, it's a little bit clearer, but because then you have the next couple of cases, Hitchens versus the Commissioner, which here you had the shareholder assume the corporation debt, and the court held there was no evidence of a direct obligation and there was lack of an economic outlay. So here the taxpayer ended up losing. Orin is a little bit different, and this is something you really want to try and avoid. The taxpayer lost, but here you had the shareholder owned 3 S corporations. 1 generated a profit and 2 generated a loss. And what they did basically was a circular transaction where the profitable company loaned the money to the S corporations with the losses, and then the S corporations with the losses turned around and loaned that money back to the profitable corporation. So that is problematic. You know, you really, you know, that's something you should really stay away from, even with the new guidance that we have. One of these circular type of loans where the money just is loaned back to the loss corporation and then loaned back to the profitable company. So that brings us, I guess, to the 2 new developments. The first is the James and Joy McGuire case, and then the second that we're going to talk about is the proposed Treasury regulations under 1.1366-2. So in McGuire, you had a case where you had a shareholder that owned 2 S corporations. They had an automobile dealership and they had a financing company. The financing company was profitable and the automobile dealership was throwing off losses. So each year what the McGuires would do is they would record a transaction where they would distribute the receivables from the financing company and then contribute those receivables into the automobile dealership, thus creating basis in the automobile dealership and taking the losses on the return. So this is what the transaction looked like. In McGuire, you had the financing company that was profitable, distributed the accounts receivable, and then contributed them to the automobile dealership. And they did this as a journal entry. But the other thing that they did was they were also very meticulous. They recorded this as a journal entry, but they had it in their corporate minutes. You know, they documented it with loans, and they did this every year, and there were payments going back and forth. So of course, when the IRS saw this, they came in and they disallowed the loss. They said it was insufficient to create basis. You know, all the same arguments that they made. There was no economic outlay. They wanted to scrutinize the transaction because it was between related S corporations, and you know, denied it under this economic outlay doctrine. And again, here you see it says it must leave the shareholder poorer in a material sense. The tax court disagreed with the IRS and they ruled in favor of the shareholders. They said the fact that it was a distribution and contribution between related parties did not preclude an economic outlay. And they said it did in fact have an economic outlay because there was a reduction of liabilities in the automobile dealership, and the transaction reduced the ability for the finance company to take tax-free distributions. So now we come to the proposed regulations under 1366, and 1366 really eliminates this whole issue with regard to economic outlay. And what it does is it says that the debt needs to be bona fide indebtedness, and the other thing that these regulations do is it confirms that that shareholder guarantees do not create basis. And of course, in the regulations, they don't define bona fide indebtedness. They do talk about it in the preamble to the regulations. It's facts and circumstances driven, and it includes this incorporated pocketbook theory. And they cite a number of cases in the preamble to the regulations. And again, this goes back to the question that was raised. But you know, if you're going to do one of these transactions, you know, they look at the intent of the taxpayer. They look at, you know, is the debt legally enforceable? Is there a note in place? Are there payments being made? Is interest being accrued? They'll look at debt versus equity issues. They'll look at whether a creditor would really lend money to this shareholder. You know, is there collateral? Is there an expectation of repayment? So all of those items, you know, you need to consider when you're advising your clients. again, the regulation does not deal with debt guarantees. Debt guarantees still do not create basis unless you actually make the payment on the guarantee. And it also did not address the contribution of an unsecured promissory note to the S corporation. So that question is still open. Again, these are some of the things that they look at: the intent, the indication of indebtedness, and the economic reality. And again, you know, the last point there is that the circular transactions should not be performed. You want to stay away from that. So I think, lastly, just to kind of sum up for our clients, you know, because we're coming into year end and we do have a lot of clients, and you know, they do have this situation where they have multiple S corporations, and some are profitable and some are running at losses. You know, one of the things we should be looking at in planning is whether or not they have basis, and trying to see if we can create basis either through contributions or maybe through distributions and contributions or loans between related companies, but making sure that we document everything to put up the best defense possible in the event the IRS comes in. Any questions? Yeah, Jim?
Well, you said that shareholder guarantees don't create basis. So if I have a loan from a bank, it goes to the S corp, shareholder guarantees it, that's no basis.
That's correct, yes.
What happens on an LLC end? Because when you're advising a client, whether you should be an S corp or an LLC, is there a difference between the two?
Yes, yeah. With an LLC, if you guarantee it, you get basis for it.
Okay, so that may be you know,
What's that, right?
it's good, right, and that may be a decision on whether you want to create an LLC or an S corp out of the box if you're going to have losses up front and a loan from.
Right, right. It's a good point. And that does make it even more complicated. I'm sure a lot of us do have clients that are both that have S corporations and LLCs, and then you run into an issue not only with the basis, but then you'll run into an issue with the state of New Jersey, you know, that you can't net the losses against each other. Yeah, you have two different buckets, right?
Exactly.
Yeah. Yeah.
Do you have a case where you made a distribution from one S to the shareholder, and the shareholder put the money into the second S, and they said that wasn't good for basis?
It is good.
That's good.
That was good. That was good for basis. Yes, that was okay.
Do you think it makes a difference if the first S corp, if it's the owners are married individuals, so like it's 100% owned from a husband, and then the other one is 100% owned from the wife? Do you think that would make a difference with the way the IRS kind of ruled on, or the tax courts ruled on those?
Yeah, I don't think that would. I think they would be. It's all flowing through their individual return.
Right.
And through attribution, I think they would be considered one. Yeah. Yes.
What are you doing to eliminate the 3.8% additional tax?
To eliminate the 3.8%. Thank you, everybody materially participated.
No, to make it active. I mean,
Yeah.
are you moving investments into S corps and then giving them W-2s for the income that's generated here?
I mean, with the 3.8%, I mean, if you're passive in the S corporation, you're subject to 3.8. If you materially participate, it's not. So, you know, you want to try. It's a good point. You want to try and get people to get over that 500-hour threshold so they're materially participating. Yes, sir.
Well, I know going back, this has to go back 5-6 years, we used to take clients, you know, if they had a $100,000 loss at the end of the year, the shareholder put $100,000 in on December 31st, we take it back out January 2nd. Now they get this thing called open debt. Is that limit still $25,000 or?
I'd have to check that, Jim. I don't know, but I know what
We
you're
used to do
talking
that all
about.
the
Right.
time until they put
It's
this.
got to be recorded open debt, and I think there's got to be, there's a
Right.
time period,
Right.
there's a
Right.
time frame.
And the maximum
Yeah.
is 24.
And I think the max is still 25.
Yeah,
We always used to like to do that because the shareholder was really only.
Right, and you pay it back on January 2nd.
4 days,
and-
right, yeah, exactly.
Right.
You got to use 2 pens instead of 1.
Anything else? Thank you.
Thank you very much, Paul.
Thanks, Jim.